Chapter 5 of The Intelligent Investor is where Benjamin Graham gets specific about stock selection for the defensive investor. Warren Buffett calls this the best investing book ever written. In this chapter, Graham gives you 4 rules for picking stocks if you want peace of mind. Hi, I am Nick, the guy with the Greek accent, and I have been a value investor for a long time. Graham wrote this book 70 years ago, and it reads like it. The language is tough, the examples are outdated. Look, I get it. You want to learn this stuff without spending 3 hours on one chapter. That's why I am breaking the book down in plain English, so you can actually learn from it. And if you are new here, this is part of a series. I would recommend starting from video 1 so you get the full picture. We start on page 113. Benjamin Graham writes about the advantages of stocks. The first was that they had offered a considerable degree of protection against the erosion of the investor's dollar caused by inflation, whereas bonds offered no protection at all. The second advantage of common stocks lay in their higher average return to investors over the years. This was produced both by an average dividend income exceeding the yield on good bonds and by an underlying tendency for market value to increase over the years in consequence of the reinvestment of undistributed profits. Graham is making 2 points here. First, stocks protect you against inflation. Bonds don't. When prices go up, your bond payments stay the same, but companies can raise prices, so stock values can keep pace. Second, stocks gives you better returns over time. You get dividends that beat bond yields, and on top of that, companies reinvest their profits back into the business. That reinvestment makes the company more valuable, which pushes the stock price up. So you are earning income and growing your capital at the same time. But Graham immediately follows with a warning. While these 2 advantages have been of major importance and have given common stocks a far better record than bonds over the long-term past, we have consistently warned that these benefits could be lost by the stock buyer if he pays too much a price for his shares. Stocks beat bonds unless you overpay. Buy Apple at the wrong price and you will still lose money. Graham is obsessed with this. Finding good stocks isn't enough. You must buy them at the right price. And I know it is tempting. When Tesla is up 400% and your friends are getting rich, the last thing you want is a calculator. But that is exactly when you need one. And he gives you a brutal example. This was clearly the case in 1929, and it took 25 years for the market level to climb back to the ledge from which it had abysmally fallen in 1929 to 1932. That's what happens when you ignore valuation. You are 42, 23 years until retirement. You buy what is hot without checking the price. The market crashes. At 65, you are back to zero. 23 years, 0 gains. You didn't lose money, you lost decades. Graham is strict about price because one afternoon of bad decisions can cost you 20 years. Only then Graham gives you his stock selection criteria. Danger first, map second. Here are his 4 rules. First rule, there should be an adequate, though not excessive, diversification. This might mean a minimum of 10 different issues and a maximum of about 30. Don't put everything in 3 stocks. Don't own 100. Graham says 10 minimum, 30 maximum. Why? Because if you own too few, one bad pick can wreck you. But if you own too many, you can't possibly keep track of them all. Graham wants you focused enough to actually know what you own, but diversified enough that one mistake won't kill you. Now here is something interesting. Graham's most famous student, Warren Buffett, completely disagrees. He says, concentrate your bets. Own just a few stocks you really understand. But Graham here is writing for the defensive investor, someone who wants peace of mind, not a full-time job. someone who has a career, a family, a life outside the market. If that's you, you need more diversification. Buffett's approach works if you are willing to put in serious work. Graham's rule is for everyone else. Rule number 2. Graham writes, each company selected should be large, prominent, and conservatively financed. Translation: stick with big, well-known companies that don't have too much debt. Graham knows these terms are vague, so he gets more specific later in the chapter. An industrial company's finances are not conservative unless the common stock, at book value, represents at least half of the total capitalization, including all bank debt. For a railroad or public utility, the figure should be at least 30%. In today's terms, debt to equity ratio under 1. The company should have less debt than equity. A company with $100 million in equity and $150 million in debt, too leveraged. Walk away. Why? When times get tough, debt kills. Companies that fund their own growth survive. The ones drowning in debt don't. Next, he explains what a large and prominent company is. To supply an element of concreteness here, let us suggest that to be large in present-day terms, a company should have $50 million of assets or do $50 million of business. Again, to be prominent, a company should rank among the first quarter or first third in size within its industry group. Graham wrote this in the 1970s. 50 million then is billions now. Fortune 500 territory. Prominent means industry leaders. Retail, Walmart or Target, not a regional chain. Tech, Microsoft or Apple, not a startup. Stick with names everyone recognizes. But then he adds this. It will be foolish, however, to insist upon such arbitrary criteria. They are offered merely as guides to those who may ask for guidance. Don't obsess over exact numbers. Graham is giving you guardrails, not handcuffs. Buy big, stable companies everyone has heard of. If you are debating whether a company is large enough, you are overthinking it. Use common sense. Now let's see the third rule. Each company should have a long record of continuous dividend payments. To be specific on this point, we will suggest the requirement of continuous dividend payments beginning at least in 1950. Graham wants decades of uninterrupted dividends. When he wrote this, that meant 20 plus years of consistent payments. If a company paid dividends through recessions and crashes, the business works. Management knows what they are doing. Graham wants proven survivors. The last rule is this. The investor should impose some limit on the price he will pay for an issue in relation to his average earnings over, say, the past 7 years. We suggest that this limit set at 25 times such average earnings and not more than 20 times those of the last 12-month period. He is saying, don't pay a PE ratio above 25 based on the company's average earnings over 7 years, and don't pay a PE above 20 based on last year's earnings. Why 7 years? It smooths out the good and bad years. A company might spike 1 year, but that doesn't mean you pay through the roof. Graham wants you looking at what the company consistently earns. Stock trading at a PE above 25 times the 7-year average or above 20 times last year. Walk away. You are overpaying. In 1929, people paid PE ratios of 40, 50, and 100 times earnings. Today, you see Tesla trading at a PE of 300. Same thing. Graham is giving you a ceiling so you don't make that mistake. Graham knows what you are thinking. This rule excludes almost all growth stocks, and he is fine with that. Growth stocks are exciting. Everyone is talking about them, but they are trading at 50, 100, 200 times earnings. They might make you rich. They can also wipe you out. If you are a defensive investor, that's not your game. You are not trying to pick the next Amazon. You are building a portfolio that won't blow up. Graham wants you sleeping at night, not refreshing your portfolio at 2 a.m. Graham believes growth stocks are dangerous, and he gives you real examples. IBM, the Tesla of its era, dropped 50%. Texas Instruments fell 80%. Growth stocks crash. He continues, the reader will understand from these instances why we regard growth stocks as a whole as too uncertain and risky a vehicle for the defensive investor. Of course, wonders can be accomplished with the right individual selections, bought at the right levels and later sought after a huge rise and before the probable decline. But the average investor can no more expect to accomplish this than to find money growing on trees. Yes, you can get rich on growth stocks if you pick the right one at the right time and sell before the crash. Most people can't. They buy high, hold through the decline, lose money. Graham's point is this. If you are a defensive investor, you are not trying to get rich overnight. You are trying to avoid losing. To manage the inherent volatility and the risk of buying at too high a price, Graham endorses the use of dollar cost averaging. This method involves dedicating the same dollar amount each month to buying common stocks, which prevents the investor from concentrating purchases at the wrong high times. Graham highlights a study that showed that applying dollar cost averaging during 23 10-year purchase periods ending between 1929 and 1952 resulted in a profit in every single test. The author of that study called it the ultra-simple investment formula that can be used with the most confidence of ultimate success regardless of what may happen to security prices. He then writes the following. It is now standard practice to submit all security lists for periodic inspection in order to see whether their quality can be improved. Graham is saying, check your portfolio at least once a year. But if you don't have the knowledge, work with a broker you trust. Look at its stock. Does it still meet the criteria? Still paying dividends? Debt still low? PE still reasonable? If not, sell it and replace it. Later in the chapter, Graham writes something very important. Medical men have been notoriously unsuccessful in their security dealings. The reason for this is that they usually have an ample confidence in their own intelligence and a strong desire to make a good return on their money without the realization that to do so successfully requires both considerable attention to the matter and something of a professional approach to security values. If you are a doctor watching this, don't take it personally. This isn't about doctors. It is about all of us. We overestimate our intelligence, especially if we have succeeded somewhere else. Top company, praised your whole life. That makes you more vulnerable, not less. Graham's point is this. Being smart in one field doesn't make you smart in investing. A surgeon can be brilliant in the operating room and terrible with stocks. Why? Because they assume their intelligence transfers. It doesn't. I also want to point out Graham's advice for beginners. We urge the beginner in security buying not to waste his efforts and his money in trying to beat the market. Let him study security values and initially test out his judgment on price versus value with the smallest possible sums. You can't beat the market, not at the beginning. Build a defensive portfolio first. Follow Graham's 4 rules. Get safe. Want to be aggressive? Fine, but earn it. Do the research. Study security values. Learn what companies are actually worth. Then test yourself with small money, tiny amounts. See if your analysis holds up. See if you can spot the difference between price and value. Most people skip this. They read one book, feel confident, and go all in. Then they lose and blame the market. Graham is telling you, prove it to yourself first. Make your mistakes small. Learn cheap. Then get aggressive. Now, before we hit Jason Zweig's commentary, you made it this far. That matters. We are drowning in AI slop and TikTok brains, but you are still here, working through Graham's logic, not scheming for hacks. Charlie Munger said it. I did not succeed by intelligence. I succeeded because I have a long attention span. You just proved you have one. That's your edge. Most people won't do this. You did. Congratulations. Now let's see what Jason Zweig adds on page 125. Lynch's rule: you can outperform the experts if you use your edge by investing in companies or industries you already understand. That rule isn't totally implausible, and thousands of investors have profited from it over the years. But Lynch's rule can work only if you follow its corollary as well. Finding the promising company is only the first step. The next step is doing the research. Peter Lynch gets quoted everywhere. Invest in what you know. Sounds easy. Costco is packed. Buy Costco stock. Done. Not done. Lynch said that's step 1. Step 2. Read the financials. Estimate what the business is worth. But everyone skips that part. They buy stocks based on full parking lots. That's not investing. That's gambling with better PR. Zweig then explains, psychologists have documented a disturbing fact. Becoming more familiar with a subject does not significantly reduce people's tendency to exaggerate how much they actually know about it. That's why investing in what you know can be so dangerous. The more you know going in, the less likely you are to probe a stock for weaknesses. This is called home bias, sticking to what is familiar. You own 3 times more shares in your local phone company than all others combined. Familiarity breeds overconfidence. You think you know the company because you use their products, but knowing the product isn't knowing the financials. Your favorite restaurant might have terrible margins. Your company's stock might trade at 80 times earnings. You won't see it. You are too close. Finally, Zweig gives you proof that Graham's dollar cost averaging strategy actually works. According to the leading financial research firm, if you had invested $12,000 in the Standard & Poor's 500 stock index at the beginning of September 1929, 10 years later, you would have had only $7,223 left. But if you had started with a paltry $100 and simply invested another $100 every single month, then by August 1939, your money would have grown to $15,571. Remember Graham's warning about 1929? Here is the solution. You didn't need to time the market. You didn't need to be a genius. You just needed to keep buying month after month, regardless of what the market did. The people who dumped everything in at once crashed, down 40% in 10 years. The people who bought consistently, up 30%. Same market, same decade. Different approach, different result. Discipline beats timing, every time. So that's the defensive investor, protected, diversified, sleeping well at night. But there is another path, the enterprising investor. More effort, and if you do it right, more reward. Click here to watch the analysis. To ensure you don't miss that crucial next step, subscribe to the channel now. And if you just joined us, click the playlist link to start the entire Intelligent Investor series from the introduction and master the foundations of value investing. Thank you very much for watching, and as always, invest wisely.